Welcome to the Generational Wealth Podcast. A recession is on the way. In today's show, I'm going to tell you how the Fed raised the interest rates for the ninth straight month and what you need to do to protect your money. All I need you to do is smash that like button. It only takes 2 seconds, but it goes a very long way to growing this channel, guys. Thank you for your support. I want to give a big shout out to everybody who checked out my free webinar on the 3 keys to financial freedom. Guys, if you have not checked out this free training, you are missing out. Now, some of you know that I own over $1 million worth of real estate. And over 10 years ago, I paid off over $95,000 in student loans 2 years after graduating from college. From that time, I've become a best-selling author, entrepreneur, and real estate investor. But most importantly, I want to show you guys how I did that. And in this 3 keys to financial freedom webinar, I'm going to show you guys how to stop trading time for money. I'm going to show you guys how I was able to build a life in my 20s that's allowed me to create passive income and create multiple streams along the way. So if you guys want to know how to create generational wealth, all you got to do is click the link in the comments below. If you're on, make sure that you leave me a comment right now. Let me know that you're here so that way I could give you a big shout out and show you some love. It's going down tonight, y'all. Tonight, we're going to talk about why the Fed raised the interest rates again and what this means for the economy. Now, I also want to give a big shout out to all of my sponsors. My sponsors keep this channel going. Guys, if you've watched the podcast, you know that I put a lot of work into making these shows come together. These shows are jam-packed with a ton of value, showing you how to create generational wealth. If you love this channel and you want to see more shows, do me a favor and donate to this platform. Whoever makes the highest donation for tonight's show will be the official sponsor for the event. Now, if you want to donate, all you got to do is give a super chat, tap the dollar icon directly below the live comments section, or you can donate through Cash App, $ in Wealth Podcast. Enough talking. Let's begin. Recession alert. Recession alert. The Federal Reserve raised interest rates again. Not for the ninth straight time, y'all. The Fed raised the interest rates again. What is happening? I got to show y'all this in an article just so y'all see what I'm saying. If you don't know, the Federal Reserve is in control of America's money supply and how the economy is run. Now, the Federal Reserve hiked interest rates by 25 basis points to curb inflation despite banking turmoil. In other words, the Federal Reserve is still playing with the economy, even though these banks are crashing. Now, here's what I need y'all to see. I need y'all to understand what this means for you because you might not care anything about the banks. You might not care anything about the federal government, but I'm sure you care everything about your personal finances, don't you? And how this has to do with you keeping food on the table. The Fed's latest move brings the federal funds rate to a range of 4.75% to 5%. It's expected to further slow economic activity as it drives up rates for credit cards, adjustable rate mortgages, and other loans. But Americans, especially seniors, are finally benefiting from higher bank savings yields after years of paltry returns. Now, guys, I always break this down for you. Don't worry about all the talk in the article. This is just to show you guys the receipts. What this is saying is that the Federal Reserve is raising interest, which means that you're going to be paying more money on your credit card debt. If you guys have a mortgage on your home that's an adjustable rate mortgage, it means that your mortgage is going to be more expensive. The reason why the Federal Reserve is raising the interest rates is because they're trying to slow down the economy. As all of you should know, inflation has been through the roof for years. And now it's time to bring stability. So, what the Federal Reserve is doing is they're saying, hey, let's slow this economy down. Let's raise up the interest rates because we know if we end up raising the interest rates, that will stop people from taking out so much debt. It will stop people from spending. It will stop people from flooding the economy with money. The Federal Reserve is trying to get people to slow the economy down. That's why this is happening. The Fed's latest move brings the federal funds rate to a range of 4.75% to 5%. It's expected to further slow economic activity as it drives up rates for credit cards. They're trying to get you to stop spending so much money on your credit cards. Adjustable rate mortgages. This is why home buying is at a 20-year low. Interest rates keep going up. Now, a few years ago, when interest rates were at zero, everybody was buying a home. But now it's come to a screeching halt. That's because the economy has to restabilize. Right now, we are on the brink of a large recession, but Americans, especially seniors, are finally benefiting from higher bank savings yields after yields of paltry returns. Now, that means a lot of you might have noticed that when you go to your local bank, they're offering you guys different accounts at higher savings rates. So some of you guys might have looked into a CD known as a certificate of deposit. Some of you guys might have a money market account, and you'll notice the interest rates on these accounts are going up. Now, that's a good thing if you have a lot of money because that means you're going to start making some passive interest. But if you're loaded up in debt, this is no bueno. You got to focus on getting out of debt as soon as you can. Everything is getting tighter. It says amid the aftershocks of bank runs that failed SVC, SVB, and another bank, the Fed faced a wrenching decision over whether to continue to back up its inflation fighting rhetoric or take a more cautious path and pause after 4.5 points of rate increases the past year. Those rate bumps at 8 straight meetings marked the most rapid flurry since the early 1980s and contributed to the crisis, raising the risk that another increase could deepen banks' troubles. Now, we got to talk about this tonight, guys. I got to tell y'all how the Federal Reserve destroyed SVB. If you haven't heard, SVB stands for Silicon Valley Bank. This was the 16th largest bank in America. When this bank collapsed recently, it put the economy through a tailspin. You even had European banks going under because of this. When you break down this paragraph, what it's saying is the Federal Reserve has been raising interest rates and it's been making the banks suffer. But now, because some of these banks are suffering, everybody questions whether or not the Fed is going to continue raising the rates. The Federal Reserve might have to look at this and say, hey, we're doing too much damage. We might have to stop and pull this back, which is what I've been telling you guys is going to happen. If you've watched some of my recent podcasts, you will know I've laid this out in 3 steps. The first thing that the Fed is going to do is they're going to raise the interest rates to try to cool the inflation. The second thing that the Fed is going to do is they're going to realize that they can't bring inflation down to 2%. They're going to do too much damage to the economy, and then they're going to pause increases. The third thing that the Federal Reserve is going to do is they're going to start to cut the interest rates. When they cut the interest rates, they're going to try to give the American consumer a little bit more breathing room. They're going to try to make things a little bit easier on the banks. Now, I went over this in greater detail in my recent video about Why the Federal Reserve can't stop inflation. Why the Federal Reserve cannot fix the inflation problem specifically. Right now, the Federal Reserve has a goal of bringing the inflation rate down to 2%. Right now, it's at 6%. And even though they've been making some progress, they're not going to get all the way back down before a lot of damage is done. Now, I just want you all to look at this paragraph one more time. It says, amid the aftershocks of bank runs, this is talking about how people are pulling their money out of the bank. People are seeing how these banks are falling, and now they want to pull their money out before they lose everything they got. The American banks are losing trust. Amid the aftershocks of bank runs that failed SVB, another bank, the Fed faced a wrenching decision over whether to continue to back up its inflation fighting rhetoric or take a more cautious path and pause after 4.5 points of rate increases the past year. Those rate bumps at 8 straight meetings marked the most rapid flurry since the early 1980s. This has been the worst economy for inflation since the 1980s. And in the earlier paragraph, it talked about how the Federal Reserve's been talking a lot about how it's going to fight off inflation, but in everything that it's done to try to stop it, now you're seeing banks shut down. Here it says the 8 straight interest rates, the increases, it's the most rapid flurry since the early 1980s, and it contributed to the crisis. I want y'all to mark that down. This contributed to the crisis. A lot of people will never tell you this, but we got to give y'all the real deal. The Federal Reserve directly contributed to all of these bank failures. And I'm going to show you guys how on the show and how that ties directly to you. You have your money in the bank, contributed to the crisis, raising the risk that another increase could deepen banks' troubles. Now, why are we talking about this? If the Federal Reserve continues its plan, we are definitely going towards a recession. The Federal Reserve is raising these interest rates, and there's a lot of people that are worried that things are only going to get worse. Now, I want to share this with you guys. Mortgages are starting to increase in its rates. This is the reason why so many people are being priced out of a home. Now, you might be wondering, what does the interest rate have to do with me? If you go to buy a home and the interest rate on a home is 7%, that means that you're going to have to pay more in your monthly payments. So if you guys are paying more in your monthly payments, that means you could get priced out of the house that you want. When the interest rates were a lot lower, the monthly payments were cheaper. But now that interest rates are higher, it's costing you more per month. This is the reason why there's stories about people who make hundreds of thousands of dollars that are still not able to buy a home where they live. Everything is so expensive. Right now, there's inflation and there's high interest rates. So there's going to be a lot of problems making big purchases. Now, the next Fed meeting is going to be in early May. So we're going to see if they're going to raise interest rates for the 10th time. But the way that the chair of the Federal Reserve is talking, Jerome Powell, he's making it sound like he's going to keep going. So they're predicting that there's going to be one more interest rate increase, taking us up to 10 consecutive increases. And that's only going to make things more challenging when it comes to managing debt, when it comes to employment. This is something that can cripple the economy. Now, let me tell you guys how the Federal Reserve is destroying banks and how you need to prepare for the upcoming crash. For 5 straight years, Silicon Valley Bank was known as one of the best banks in America. If you look it up, you would see they won awards every year. Now, the thing that's so bad is, even though Silicon Valley was winning all of these awards, obviously, they didn't have the right management over their banks. If out of nowhere their bank just collapsed, where was everybody monitoring the funds? And this was one of the best banks in America. That should tell you something. But I want you to see this is not just about the banks not having the right management. This is about how the Federal Reserve adds fuel to the fire. Remember, the job of the Federal Reserve is to watch the banks to make sure that they're properly regulated. But for some reason, this bank went under. Nobody knew what was going on. 16th largest bank in America, it's coming crashing down. So not only is the Federal Reserve raising these interest rates, which is making problems happen to banks, they're also not giving proper oversight. And as you guys know, the Federal Reserve has been raising interest rates since March of 2022. Now that's caused all kind of problems to the economy. The only thing about this is it's not just the Federal Reserve hasn't been watching these banks. It's not just the Federal Reserve has been raising the interest rates. You got to see how the Federal Reserve has been damaging these banks through bonds. We don't talk about how, when the Federal Reserve raised the interest rates, that created a big gap between the government treasuries and the bank's bonds. Now, when we talk about the bank bonds, how many of you guys have heard of bonds before? You know, some of y'all's grandmothers might have bought you one. I remember my mom, when I was 2 years old, she bought me a bank bond for a couple $100. And man, it felt so hard to finally cash this thing in as an adult. A lot of you guys might have gotten it for the holidays by your grandparents. Bonds are something that the banks lend out to try to give you a promise on money. The government also does this with treasuries. When you have a treasury, this is where you're loaning the government money. What happened over the past year is banks bought bonds and the government issued treasury. When the government issued treasuries, they gave it out at a lot higher interest rate than the banks had bonds. So the Federal Reserve, they kept raising the interest rates, but the banks were slow to increase the interest rates that they offered to their customers. So what happened? Because the Federal Reserve started raising interest rates so quickly, the banks didn't keep up. This meant that a lot of people put more money into treasuries than they did into their local bank. When all this money went to treasuries, it started to cause banking problems. The banking sector over the first 3 quarters of 2022 lost over $1 trillion because of this issue. I want y'all to see this. The government was out here doing their own thing and the banks weren't catching up. They were not aligned. And that's the reason why you're seeing all of these banks start to crumble. Not only did the Fed raising interest rates create a gap between the treasuries from the government and the interest rates that were coming from bonds, I want you guys to also consider in 2022, interest rates went up a lot from 0 at the beginning of the year all the way to 4% by the end of the year. And as a result of the interest rates going up, that means that the prices on those bonds fell quickly. This means that if a bank bought bonds before the interest rates went up, they would have seen a big decrease in the value on their paper. Let me explain why. When the government goes up on interest rates and the bank issues bonds, when new bonds are released with higher interest rates, investors want to buy those over the older bonds. The reason why they like the newer bonds is because it comes with a higher interest. The older bonds have lower interest from before. So just imagine the Federal Reserve keeps raising the interest rates month after month after month after month. So all of the bonds that people had before started getting weaker and weaker by the minute. That's because the newer bonds give a better return on your investment. That made the older bonds less appealing. So let's talk about that. When the interest rates change, the value of bonds can go up or down. If a new bond is released with a higher interest rate than the older bond, then people are going to want to buy the newer bond instead. The older bond becomes less valuable, the price goes down. And normally that wouldn't be a problem because the bank that owns the bonds would hold on to them until it reached its maturity, until it reached its term for a bond. These bonds have a timeline. But if the bank needed to sell the bonds quickly, because a lot of customers are pulling their money out of the bank, so the bank needs to find a way to make more money. If the bank needs to sell these bonds quickly, that means that you're going to have to sell the bonds at a lower price than what they paid for them. This meant that banks are taking a loss. This is exactly what happened to Silicon Valley Bank. This bank had to sell $21 billion worth of bonds at a loss of almost $2 billion. As soon as customers found that out, they decided to pull their money out of the bank because they were worried that the bank was about to collapse. This is how the banking system works. One of the things that led to the bank crashing is poor risk management. The banks did not properly manage the risk. Federal Reserve keeps raising the interest rates. The banks aren't paying attention. When the Federal Reserve raises the interest rates, all of the value of a lot of these banks go down. And I want you to know how that's going to affect your money. But before I go further, make sure that y'all leave me a comment. Ariel says, what will make them stop raising the interest rates? More crashes. When you guys see a lot of these banks collapsing, that's going to put so much pressure on the Federal Reserve to take a halt. Now, remember, I talked about this in the live about why the Federal Reserve can't fix inflation. The reason why they can't fix inflation is because the lengths that they would have to go through to try to get out in front of this problem is going to make too many people and businesses suffer. They're gonna get too much pressure and they're not gonna do it. Then they're gonna have to stop raising the interest rates. Then they're going to have to start cutting the rate to give a little bit more comfort. A great question, Ariel. If anybody else has questions, feel free to leave me a comment. I definitely want us to talk about that at this time. Make sure that you smash that like button, guys. Tonight we're talking about how we're on the brink of a recession. Let's get these likes up. Let's get these likes up. Smash that like button. The Federal Reserve raises the interest rates again for the ninth straight time. We're going to talk about what that means for you and your money. Now, when the Federal Reserve raises interest rates, things happen in the economy. There could be another interest rate increase happening in May. But guys, before we talk about that, I want us to talk about how all the while this has been happening, the Federal Reserve keeps making the promise, "Oh, the economy is in good shape. Everything will bounce back. Everything is fine." But you see unemployment on the rise. You see all of these banks collapsing and shutting down. You see all of these different things happening, and you start to wonder, what's next? This is the next big thing that a lot of y'all aren't aware of, but I need y'all to be aware of it because this can cause big disaster for a lot of us that have money in the bank. Look at this. Close to 190 banks could face Silicon Valley's bank's fate, according to a new study. This article shows there are 190 banks that could collapse over the next few weeks. And this is something that's really scary, guys. A lot of us got our money in the banks, and I'm not saying that we should pull all of our money out, but we do need to pay attention to what's coming. Watch this. On the heels of Silicon Valley's banks collapse earlier this month, 186 more banks are at risk of failure, even if only half of their depositors decide to withdraw their funds, a new study has found. I want y'all to notice that. What this is saying is, even if half of the people who do business at these local banks decided to pull out their money in fear of a crash, there's almost 190 banks that would go bankrupt because of it. This would collapse our financial system. That is because the Federal Reserve's aggressive interest rate hikes to tamp down inflation have eroded the value of bank assets such as government bonds and mortgage-backed securities. The recent declines in bank asset values very significantly increase the fragility of the US banking system to uninsured depositor runs, economists wrote in a recent paper published on the Social Science Research Network. Now, a little bit earlier, Ariel asked the question, what will make them stop raising the rates? Well, if inflation goes down a lot faster, that's another reason why the Federal Reserve would stop raising interest rates. Even though they keep raising the interest rates, people still are spending a lot of money. Businesses are keeping prices very high, and the Federal Reserve keeps going. But as you can see, all of these economists are pointing out that when the Federal Reserve raises the interest rates, it only makes it that more likely that we're gonna see one of the biggest economic disasters since the Great Depression. Almost 200 banks on the verge of collapse, thousands upon thousands of people getting unemployed. I showed you guys in a recent podcast when Jerome Powell went to speak to politicians, they talked to him about the possibility of 2 million people out of a job by the end of this year. So, guys, with all of this going on, we have to get very prepared. We cannot be asleep right now. We have to pay attention to what's going on in the market because if this catches us off guard, a lot of us could be on the street. Now, I'm gonna show you all one last article, and then we're gonna go into what this means for you. Fed rate hikes will trigger a downturn of greater speed and magnitude than the Great Recession. Economists, US recession will hit everywhere all at once. Watch this, guys. As the Fed enters its final moments on its discussion over interest rates, economists on Mornings with Maria signaled that their verdict could trigger a recession like 2007 and 2008, except at a greater speed and magnitude. So you got economists saying that we're on the verge of something worse than what happened then. If y'all remember the 2008 crash, that was bad. Now there is danger that this could be worse than that. It's not gonna be confined to real estate because when the 2008 crash happened, remember that came from the housing crisis. It's not gonna be confined to real estate. It's not gonna be confined to the banks. It's not going to be confined to corporate credit. This is really like 2007, 2008 all over again, except I think it's going to evolve even faster than it did then because of the speed and magnitude of the Fed rate hikes. Now, the Federal Reserve has already been labeled for making a terrible mistake by letting the interest rates be so low for so long. The reason why they're trying to increase these interest rates so quickly now is because there was a large period of time where they let the interest rates stay low. If you guys remember what happened with the pandemic, interest rates went to zero. But they're saying that the interest rates were at zero for too long. Now America is struggling. There's a serious problem with the financial institutions because of the Fed policies and also because of fiscal policy. Former Reagan administration economists Art Laffer added, I think there are a lot of cracks in the system, and I think we're just beginning the financial problems because you're going to see this pop up in all sorts of other areas because of leverage and because of a very sharp rise in interest rates. Now, guys, I always tell y'all when you see a bank collapse, you haven't seen the worst of it over a matter of days. Everything is going to unfold over the next few weeks and months. We have not seen the worst of what is happening yet. It takes time for these things to hit the market. When the Federal Reserve raises the interest rate, don't think, oh man, immediately there's going to be an instant effect. No, over time, that's when it's really going to be felt in the market. So, prime example, some of you guys might start to feel prices going up at the gas station. It doesn't happen overnight. Some of you guys might to start to feel the long-term effects of grocery prices going up over time. Whenever the market changes, it always takes time before it comes to the average person. So now we're going to talk about how all of these interest rates can damage the economy and how it can spell disaster for me and you. Now, the first thing that you need to know about the Fed raising the interest rates for the ninth time is that this will tighten credit. A lot of Americans rely on credit to survive. Higher interest rates could make borrowing more expensive for customers and businesses. This could lead to reduced lending and borrowing, which could make the economic slowdown worse and put more pressure on the already struggling banks. Now, guys, I need y'all to see what's happening here. Most Americans have some form of debt, credit card debt, car loan debt, personal debt, the list goes on. Student loan debt, how could I forget about that? Most Americans are in debt. Now, if most Americans are using debt to survive because they cannot afford their cost of living through their 9 to 5 jobs income, then that means as the Fed raises the interest rates, you're not going to be able to borrow. If you're not able to borrow, you're not going to be able to afford what it is that you're paying for right now. And this is the reason why I always tell you guys to strive really hard to get out of debt and to try to budget your money in a way where you don't spend beyond your means. For some people, you haven't felt the effect of these interest rates fully just yet. But trust me, if these interest rates continue to go up, You will. Higher interest rates means it's tighter credit. It's going to make borrowing more expensive. For every time that you use your credit card, the interest rates are going higher and higher. If you have a home on an adjustable rate mortgage, it's going to be more expensive. You're going to feel the effect. And because the Fed is raising the interest rates, less people are going to be likely to borrow because they can't afford it, which means that banks are going to lend less and less because there's less people who can afford it, which means it's going to slow down the economy, which is what the Fed wants, but it's going to put more pressure on the banks to survive. Banks make a living off of borrowing. They take your money and they lend it out to other people. Now, let's talk more about these banks that are already in trouble. If the banks where you and I have our money is already in trouble, the Fed raising the interest rates is only making things harder. Why? Because higher interest rates can make it harder for them to pay off their own debt. Now, I hope y'all don't think we're the only ones out here paying off debt. No, these banks have debts too. So, the same way I'm telling you guys about how important it is to get out of debt because things are getting that much more expensive if you're borrowing, when the Fed raises the interest rates are going up on the banks too. For all of the money that they've borrowed, it becomes more expensive for them to afford paying off the debt. Now, what happens if the banks can't afford to pay their debt? That's when you have bank failure. That's when you have the domino effect of one bank going under, another bank following. A lot of you guys are starting to see how all of these banks are tied together. Another thing that we're not talking about is what this means for the global economy. When the Fed raises the interest rates, that causes international movement. When interest rates increase, that means that investors may stop investing more money in some of these other countries. Why? Because the US dollar is getting stronger. When the Federal Reserve raised the interest rates, that can make some of these investors want to keep more money to themselves, more money in house. You'll have less money floating through the global financial system, which can cause a lot of problems. I just want y'all to notice all of this Fed talk isn't just about America. What the Fed does can influence what happens throughout the world. Now, you might have heard me say higher interest rates might make the US dollar stronger. The US dollar might get stronger than that of other currencies. That means if the US dollar gets stronger, that can hurt outside countries who buy goods from America. This is talking about US export. So if you've got all of these other countries buying goods from America, now it's more expensive for them. And so one of the things that I really want you guys to think about is, okay, well, if these other countries are not able to buy from America like that, how's that gonna slow things down? It's not just gonna slow things down in America because America's not able to export its goods. That's also gonna slow things down worldwide. There's a global economic system. Next thing you wanna think about is inflation. The Fed is trying to slow down inflation. Everything costs an arm and a leg, but slowing down inflation comes at a cost. They're doing this all in the name of trying to stabilize the economy. Now, let me give a big shout out to my sister Mimi. Thank you so much, Mimi, for the $5 super chat. Thank you for starting us off. Please make sure that y'all smash the like button. Tonight, we're talking about a recession alert. The Federal Reserve has raised interest rates for the ninth consecutive time. Here's what that means for you and I. I know you've heard about this. I know you've seen it in the news, but you're probably asking, what does this mean for me? I'm breaking down everything that this means for you. When interest rates go up, that means the borrowing slows down. That can make it harder for you to get by. Shout out to Sis Hanaya, so good to see you on as always. For those of you that are on, please make sure that you like, make sure that you donate, y'all. Let's get the donations up, okay? Just like Mimi did, don't have to be nothing too crazy. But please donate something to keep this channel going. All you got to do is tap the dollar icon directly below, and I definitely appreciate any donation that y'all can give. Let's talk about how the Federal Reserve is raising the interest rates and how this might be a time to encourage saving. So, if you haven't saved any money prior to this point, now is the time. Why? Because if unemployment goes up, which it will, if you lose your job, you might want an emergency fund. I've been telling you guys, make sure that you have an emergency fund in place. 3 to 6 months worth of expenses. Guys, if you lose your job because the Federal Reserve is out here going crazy, it could take some time before you get another employment. Also, you wanna think about these banks that are collapsing. If the banks collapse, you wanna make sure that you have some money set aside for that. Now is the time to really make sure that you have some money stashed away, because we don't know how crazy this is going to get. This is really just the start of the year, guys. We're not even officially past the end of the first quarter. Banks could improve, but most of them won't. Some of these higher interest rates can actually increase some of the bank's profitability. But ultimately, guys, the outcome of raising the interest rates during this time of financial crisis is something that we're all gonna have to just sit back and watch. Everybody is saying this is like 2008 all over again, and the Federal Reserve and the US government don't seem to be on the same page. The government is not on the same page with the banks. Everybody is just in doing their own thing, and we're caught up in the middle of all of this. So, during this time of economic crisis, here's a few things that you can do to protect your money. Number 1, keep your eye on your bank. Right now, with 190 banks on the verge of collapsing, you wanna make sure that your bank is in good standing. You need to see, "Hey, is my local bank where I keep my money making any announcements about what's happening? Is my local bank making announcements of having to sell off a lot of its bonds?" One of the first signs of a bank going under is they're trying to sell off as many of its bonds as possible. So that way, if people start to pull money out, the banks can still afford it. Now, I want you all to know something that's very scary. The FDIC is trying to bail out a lot of these big banks, even if the people that made the deposits went over the $250,000 limit. FDIC does not have enough money to support all of these banks going under. I'm gonna just tell you all that right now. The FDIC has billions in insurance. These 200 banks that are on the verge of failure, we're talking about trillions of dollars. FDIC does not have enough to bail out all of these banks. So I'm warning you, keep an eye on your local bank. Now, again, when we first heard about this, I did a show and I told you guys, you want to have your money right now in multiple banks. If you guys have some real money stored away, you might not want all of your money in one bank because if that bank goes under, so does all of your money. I have my money in multiple banks. I have one bank for my personal checking and saving. I have another bank for my long-term cash reserves. I have another bank for my business money. I don't keep it all in the same place. That way, if any one bank goes under, I still have at least 2 other banks for me to survive. If I lose money with my day-to-day bank, well, hey, I got my cash reserve bank. If I lose money with my cash reserve bank, which I would hate to see happen, I still have business money that I can pull from. This is the reason why the average millionaire has 7 different streams of income. The reason why they have these 7 different streams, guys, is so that if any one thing crumbles, you still have safety in other areas. Now, let me look at this question from Sis Naya. Are there any recommendations on how to stash your money if you don't want to use banks? Right now, Bitcoin is going up. Watch that video that I did last Friday, Sis Hanaya, about cryptocurrency and how the government is trying to attack crypto. The reason why the government is trying to attack crypto is because they know if the banking system loses trust, a lot of people are going to look to put money in Bitcoin and gold. Right now, Bitcoin and gold may be big winners in everything that's happening. The reason why they might be big winners is because there's a lot of people that's losing trust in the US dollar. If the US dollar were to collapse, you want to have currency in other ways. I know I'm watching the crypto space very closely right now. Just to be completely honest with you guys, I'm moving a lot of my money around right now, so that way I can make a heavier investment in crypto. Now you need to watch that video that I did before you put money into crypto blindly, because I warned you, some of these different crypto coins could actually end up taking a hit. My sister Hanaya with the $5 super chat. Thank you so much, my sister. I really appreciate that. Shout out to you and Mimi for this $5 sponsorship, guys. I really appreciate your donations. Anything that you guys can donate goes a really long way, and I really appreciate it. I try to put my all into giving you guys a lot of quality content. So for you guys to be able to give back to me for all that I give to you is much appreciated, and I really don't take it lightly. So thank you so much, Sis Anaya. For those of you all that are just now coming on, make sure that you smash that like button. If you guys are getting a lot of value from this show, please donate to the channel. It goes a very long way. Right now, we got some $5 super chats. A $10 super chat might be the winner and the official sponsor of the show. Who knows? Okay, guys. So now we're talking about why we know a recession is coming. I've seen articles that have said that a recession is guaranteed to come. But what do you need to do during this time to protect your money? Like I said to Sis Anaya, number one, you need to start researching alternative currency. You can have money in a mattress, but you need to have other streams. I recommend that you guys have a little bit of money in the mattress. That's just for basic emergencies. You have a little bit in cash, but you guys also need to start looking into some of these alternative forms of investing. As you guys know, I own real estate, I own stocks, I own crypto, I'm a business owner. The reason why my assets are so scattered, guys, is because if anything happens in one area, I still have protection from another. If the real estate market takes a hit, I still have money in other places. As you create generational wealth, you want to spread that wealth around to make sure that it survives from one generation to the next. Okay. A lot of people lost their generational wealth during the 2008 crisis. Why? Because if you had all of your generational wealth locked up in your 401k, you lost it. If you had all of your generational wealth locked up in real estate, you lost it. You got to have multiple streams of income. You got to have multiple forms of investments. Keep an eye on your bank. Make sure that your bank isn't going to be one of these banks to go under. Stay informed on their news. Go to their website. Make a phone call. Do whatever you got to do to keep your eye on that money. Now, the next thing that I want you guys to think about, even with that, is make sure that you're banking at a bank that's FDIC insured. If your bank is not FDIC insured, you should probably pull that money out. The next thing that I want you guys to think about, like we talked about a little bit earlier, is diversification. Making sure that you have money in different places, stocks, bonds, commodities. These are all things, guys. Man, I had done a show a couple months ago where I was telling you guys about treasury bonds right now. This is another thing that I want us to talk about. You remember how I mentioned earlier about how the Federal Reserve actually collapsed some of these banks because all money started flowing to treasury? Right now, you could get a US Treasury bond for almost 7%. That's really good. A 7% return on your investment through a bond. A lot of people have been investing their money there. But guys, you know what I want to tell y'all? I want to tell y'all this is the reason why it's so important for you to stay ready so you don't have to get ready. See, what rich people know is there's going to be different opportunities that's going to happen during different times in the market. So when wealthy people have money set aside, they're able to take advantage of a government bond that's backed at a 7% interest. The reason why people profit so much off of this is because US bonds are looked at as one of the most safe forms of investing that you could ever have. I mean, if you just put your money into the stock market, it could go one way or another, guys. You don't know what's going to happen with that money. But if you put your money into a treasury, there's a really good chance that you're going to get your money back. Why? Because the money that you put up is backed by the US government. That's a lot safer than crypto. It's a lot safer than a random stock. If you have government promised money, that's the number one people that you want paying you on time. Why you think a lot of people invest in real estate with Section 8 properties? This is just a some free game for you guys on real estate investing. You can invest in real estate and buy Section 8 property, and you don't have to worry about the stress of getting money from your tenant. The reason why you'll see wealthy people buying up Section 8 properties is because they know that they're gonna get paid on time by the federal government. Now, if you have real estate like I do, you have to depend on the tenant to be able to come through on rent. You don't know what day they're gonna pay it. You don't know how things are looking when it comes to their finances, whether or not they've lost their job. It's not guaranteed. But when you have investments through the US government, that's as close to guaranteed in this life that you're going to get, okay? If you're thinking about investing in real estate and you wanna go through Section 8 provides good returns because you're getting government money. The only downside to Section 8, which is very important, is typically Section 8 homes are a lot easier to be vandalized because the person that's living in it isn't putting up the money. So they might not have the same regard for the home on average as people that are paying for it themselves. You want to know this kind of trade off if you're doing real estate investing. But right now, we're talking about treasuries. There are US treasuries. You'll need to look this up. There are US treasuries that are giving a 7% return on your money. Look it up. Series I. Just just type it in Google. Just type it in for that series treasury bond, you could get 7% on your money. But what good is having it if you don't have enough money to put towards it? That's why you gotta stay ready. And that's why this leads to my next point of save more money. During this time of money uncertainty, it's a good idea for you to save your money. Really make sure that you're getting a handle on your budget, guys. Make sure that you have a good financial cushion. So that way, if you lose your job, you have protection. Again, I want you guys to think about this. Right now, unemployment is at a record low. The Federal Reserve is trying to change that. Federal Reserve, they're raising the interest rates, which is going to raise unemployment. We don't know what levels it could get to by the end of this year. Millions of people could lose their jobs, and I hope that you're not one of them. But just in case, save your money to give you peace of mind. The average American could not survive 1 month out of work. I need to make sure you guys got this protection so you're not on the street, y'all, all right? So, last but not least, as always, I really recommend, I urge you, stay watching this channel because as I promised you, I would give you guys the latest and greatest details about what's happening in the marketplace, and I would break it down for you guys so that it's simple to understand. When you guys come to this channel, I don't want you guys to be intimidated. "Oh my, I don't know what inflation is." I'm gonna show you what that means. If you don't know what inflation means, if you don't know what treasury means, this is the channel that you go to understand money the easy way. Okay, guys? So thank you all so much for tapping in with me as always. I really appreciate all of the support. Sis Naya says, "Are there banks you would recommend that are FDIC?" Chime, SoFi, etc. I have one that is FDIC and one NCUA, but considering opening 2 more FDIC elsewhere. Where can we purchase gold besides jewelry? That's a great question. Now, a few things. One, I always recommend banking through a credit union. Some of you guys are at bigger banks like Bank of America, Wells Fargo, and Chase. Those come with a lot of hidden fees. I like using credit unions because it doesn't come with any hidden fees, and you can pull your money out from an ATM almost anywhere, and they will reimburse you the amount that you paid on the merchant fee. You know how when you guys go to the mall and you might pull some money out of the ATM, it's going to ask you, do you want to spend $2 or $4 on this merchant fee to pull from this ATM? Instead of you guys only going through your bank's ATM, at a credit union, you can go to an ATM anywhere in the country. Now, you want to make sure that your credit union offers that as a perk. I know where I use my credit union, it allows me to go to these different ATMs and it'll give me a full refund on whatever it is that I spent. If I spent $4 having to pay a merchant fee, it's gonna give me a reimbursement of that at the end of the month, so I never have to worry, "Oh, man, I gotta find my credit union's ATM." And then I'm able to go to other credit unions that are in my local area, and I can make deposits in those banks. I'm not just limited to that bank only, okay? So that should answer, are there banks you would recommend that are FDIC? I always like credit unions. Credit unions are also FDIC insured. You said that you have one that is FDIC and one NCUA, but you're considering opening 2 more FDIC elsewhere. This is a good time, guys, if you have some extra money set aside, for you to check out bankrate.com. Check out bankrate.com. Look into some money market accounts that offer high interest rates. One of the ways that you can take advantage of the interest rates going up in the economy is to get a money market account that keeps adjusting whenever the Federal Reserve raises interest rates. So I've had people ask me on this channel, "Hey, do you think right now is a good time to get a CD, a certificate of deposit?" Well, for me, I've always wanted to go for the money market account. One, because I didn't want my money to be locked up. I wanted to be able to touch the money if I needed to get it. With a CD, you have to be locked in for a certain window of time. But another reason why I personally like the money market over the certificate of deposit is because when you get a CD, it's already locking you in at that fixed rate. When I get a money market account, that's when, if ever the Fed raised the interest rates, my account goes along with it. And so every month, I've been seeing a lot of money in interest just by having my cash reserves in the account. And every month, without me doing anything, I'm making more passive income. That's how I'm able to capitalize off of the Fed raising the interest rates. So for all of my generational wealth builders, this is what I want you guys to understand. No matter what's happening in the markets, there's always an opportunity. There's always a way for you to capitalize on what's happening in the market for your own benefit. Let me give you guys another example. When inflation was going up in America, I was winning because I own multiple real estate properties that appreciates in value. When inflation goes up, so does real estate. And so I was able to see $100,000 plus gain in the massive inflation run that took place over the last 2 years. If inflation is going up, I have a way to win. If inflation is slowing down, I have a way to win. You have to make sure that you strategize your money in such a way that your winning is in all seasons. And that's why you need to know, hey, what's your recession strategy? What's your inflation strategy? These are things that I talk about a lot, guys. And I'm really gonna start maybe opening up maybe some consultations. Some of you guys might wanna work with me, one-on-one privately. Let me know if you guys would be interested in that, and I will look into doing it. Maybe I'll even put out the link for tonight's broadcast. Shout out to my brother Ian. He said, "Glad you're back on the channel." Yeah, man, it was a busy, busy week, my brother. As you know, we had a church holiday a little bit earlier this week with our Feast of Purim. And boy, between that and this past Saturday, I've been working like a Hebrew slave. So happy to be back on the channel. Y'all, I'm so sorry that I missed out on Monday and Wednesday. Your boy was rolling for a while, guys. We were rolling consistently Monday, Wednesday, Friday. I'm trying to get back on my feet. I need your support. If you guys enjoy these podcasts, I'm really considering how I want to move forward with these guys. If you enjoy me doing these videos, please donate to the channel, okay? I'm not asking y'all to put up millions of dollars. All I'm saying is $5, $10. If you wanna donate more than that, I definitely appreciate it. To super chat, all you have to do is tap the dollar icon directly below the live comments section. Your donations go a very long way, more than you can ever imagine. Also, if you're watching this podcast after the show is over, you can still donate by going to Super Thanks. Okay, that's directly under the YouTube video. Also, if you guys like using Cash App, you can Cash App me, $ Gene Wealth Podcast. If you guys like using PayPal, paypal.me/Uzziah Show. Okay, the information is rolling right now across the screen. Okay, guys. So listen, thank y'all so much for tapping in. Imma keep you posted whenever Imma have another show. Imma try to see if I can do another show tomorrow, but I won't make no promises. Thank you so much to everybody that smashed that like button. If you haven't yet done so, please make sure that you do it. If this is your first time watching the channel, make sure that you subscribe and turn on the notification bell so you can receive another alert whenever I have another show. Please don't keep this channel a secret, guys. As much great content as you guys get from me on a weekly basis, I would surely appreciate it if you told your family and friends about it. Let's grow this movement. Let's work harder to create generational wealth in our community. Also, I want to give a big shout out to my sponsors for the show. Shout out to my sister Hanaya with the $5 super chat. Shout out to my sister with $5 super chat. Two dear sisters of mine. Thank you so much. Really appreciate the support, ladies. For anyone else that wants to donate, it's not too late. All right, y'all. Stay safe during this time, guys. Okay. We're not just talking about money right now. When people money get funny, that's when crime is on the rise. Stay safe, protect yourself, and most importantly, stay focused. All right. I love y'all. I'm praying for y'all. And until next time, y'all, keep pushing.